Hey everyone, welcome back to Corporate Decoder, the place where we decode the language of big business. Today we're diving into a report from Las Vegas Sands, and trust me, this one's got more twists than a Vegas casino. We're talking about debt, interest rates, and what they're planning to do with a whole lot of cash. It's a bit like watching a high-stakes poker game, but with financial statements. But before we begin, if you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below. So, Las Vegas Sands just finalized a big money move. They successfully sold $1 billion in what they call senior notes due in 2028 and another $500 million in similar notes due in 2030. These are basically IOUs. The company is promising to pay back this money plus interest by those dates. Now, where did this money come from? It was an underwritten public offering, which means banks help them sell these notes to investors. What's really interesting is what they plan to do with this huge pile of cash. First, they're going to pay off some existing debt, specifically $500 million in notes that are due in June of 2025. Think of it like refinancing your house to get a better interest rate or payment terms. Then they'll cover fees and expenses related to this whole process. Finally, the rest of the money is for general corporate purposes, which includes potentially buying back their own stock. This last part is a signal that the company thinks its stock might be undervalued, so they are literally investing in themselves. Now let's talk about what these notes actually are. They're unsecured, meaning they're not backed by any specific assets like buildings or equipment. They're senior, which means if Las Vegas Sands runs into financial trouble, these notes get paid back before some other debts. Importantly, the company's subsidiaries, meaning the smaller companies under the Las Vegas Sands umbrella, don't guarantee these notes. So if one of those smaller companies goes belly up, these note holders don't have a claim on their assets. These notes were issued under something called an indenture. Think of it as the detailed contract that outlines all the terms and conditions of the debt. It's a legal agreement between Las Vegas Sands and a trustee US bank trust company, who represents the people who bought the notes, the note holders. Here's where it gets even more interesting. The notes due in 28 will accrue interest at a rate of 5.625% per year, and the ones due in 2030 get 6.0%. This interest is paid twice a year. So for every $1,000 you invested, you'd get roughly $56 or $60 a year, split into two payments. Las Vegas Sands has the option to redeem or buy back these notes early, but they may have to pay a premium, an extra amount. Before specific dates in 2028 and 2030, they might have to pay more than the face value of the notes if they want to redeem them. After those dates, they can redeem them at 10% of their value plus any unpaid interest. There's also a clause related to gaming authorities. If regulators in the areas where Las Vegas Sands operates casinos require them to redeem the notes, they might have to do so. Furthermore, if there's a major change in control of the company like a merger or takeover, they have to offer to buy back the notes at 101% of their value. The indenture also includes some restrictions on what Las Vegas Sands can do. They can't easily take on more debt that's secured by their assets, which is incurring lands, and they can't do things like sell off their properties and then lease them back. They also can't merge with another company or sell off all their assets without following specific rules. Finally, the indenture outlines what happens if Las Vegas Sands fails to meet its obligations. These are events of default. This could include not paying interest on time or violating the covenants we just discussed. If a default occurs, the note holders could potentially demand immediate repayment of the entire debt. Alright, that's a look at this report. What's my take on all of this? Las Vegas Sands is essentially playing a financial game of chess. They're using new debt to pay off old debt, potentially at a lower interest rate. This can free up cash and improve their financial flexibility. The fact that they might buy back their own stock suggests they believe in the company's future prospects. However, taking on debt always carries risk. If the company's performance falters, these debt obligations could become a burden. A potential risk is the heavy reliance on the Asian market, where they are exposed to regulatory changes and economic downturns. Also, changes in consumer spending habits can affect their business. Overall, it seems like Las Vegas Sands is making strategic moves to position itself for future growth. Whether these moves pay off remains to be seen. Alright, that's our breakdown of Las Vegas Sands' latest filing. What's your take on these moves and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.